So in today's video, we'll be taking a look at the Unilever stock, ticker symbol ULVR. Before getting to the video, guys, if you're new to the channel, definitely consider subscribing. I'm on a goal to get to 2,000 subs. And also, if you like this video as well, definitely consider smashing that like button for the YouTube algorithm. It really does help boost the channel out loads. So I'll just be giving my review and analysis based on the Unilever stock, just going into a bit about valuation of the company, earnings, etc., dividend, all the good stuff. So I'll keep some key information about Unilever now. Founded back in 1930 in the personal products and household sector with a current market cap of 113 billion with 2.62 billion shares outstanding. Unilever own a lot of different companies. You can see on this graph now, a lot of companies that you probably use daily in many different sectors really. So you've got household products such as VO5, etc. Then food products like Magnum, so Ben and Jerry's. You can see a lot of these companies Unilever own, and you probably didn't really know a lot about, but yeah, that's exactly why they're such a big company and why I'm a massive fan of them. Now onto the key part, which will, for me, is the earnings and revenue. If a company is not profitable, then it's not worth investing in, is my motto. So as of June 30th, 2020, they had a 51.56 billion revenue, keeping just under 6 billion of that in earnings. So the earnings is basically what they keep after they've paid all expenses and before they distribute earnings out to dividends to shareholders. So an 11.4% profit margin, a high quality earnings, although the profit margin is 11.4%, it's lower than last year's margin of 18.4%. The forecast earnings growth of 6.3% per year is above the savings rate, so they're earning more than what they'd get from a bond, lending off a bond. And although they do have a high growth earnings, it's forecast to grow but not significantly, and the revenue also at 2.9% per year is forecast to grow slower than the UK market. So they're still again in revenue, but a lot of revenue, but it's slower than the average of the UK market. And again, it's forecast to grow slower than the average of 20% per year. So let's take a look at the future now of the earnings forecast and revenue. So by 2024, again, this is forecast, so it's not really true, it's just what analysts predict. So they'll have a revenue of 58.57 billion, keeping 7.32 billion of that in earnings. So again, it's just take it with a pinch of salt, that's just what is predicted. Unilever's debt to equity history ratio analysis. So they currently have 26.95 billion in debt with an equity of 18.24 billion, meaning they have 147% debt to equity ratio, which is considered quite high. You can see the debt has risen over the last 3 years, and the equity, which is the assets minus the liabilities. You take away assets from your liabilities, so that's just one thing to be sure of. It's like I just said then, a high debt to equity ratio, but they do have good debt coverage, which is operated by 34% operating cash flow, and the interest payments are well covered by the earnings before interest tax as well, so they seem to be dealing with the debt quite well. So the short-term and long-term assets, the assets in the short term don't outweigh the liabilities, but we're more looking at long-term. So they have 52 billion worth of assets and 31 billion in liabilities. Liabilities is what take money out of a company, and assets is what bring a company income generally. Another look at the balance sheet, just basically just showing obviously long-term assets, receivables, short-term investments, inventory and physical assets, and obviously the debt of 26 billion, accounts payable, other liabilities, and the equity overall. So it's 18.2 billion in the equity. Unilever get a nice just 9% on return on assets, which is better than the industry average. Currently, Unilever's share price at the time of filming this video is £43.35, just slightly below what Simply Wall Street think is a fair value, only about 8% undervalued. So obviously, again, if you obviously do a bit more research looking to see how undervalued they actually are, but this could be a good time to buy them if you feel like they're undervalued. Now we'll take a quick look at Unilever's dividend. So they get a 3.44% dividend yield and a 5 out of 6 score on the Simply Wall Street analysis. They have a nice steady stability of growth and payments with the dividends per share of 1.642, in line with the dividend yield of 3.4%. So the dividend yield and dividends per share are on a slightly same page, which is good to see. The dividends per share have been stable in the past 10 years. They've also increased their dividends as well over the past 10 years, so it's nice to have a nice little dividend growth company. They currently have a 73% payout ratio. That's basically how much of their earnings they actually do pay as dividend. So they keep around 20% at the moment, so they're not putting all their earnings into the dividend. It's nice to keep a little bit of that in case of emergencies. And in the future, they're going to be paying slightly less, but they're forecast to earn more in earnings, so it does make sense that it does go down. Usually if they have higher earnings and they pay lower, it's generally better, so they're forecast to recover by their earnings still in the future. So that is pretty much the analysis of Unilever, guys. Let me know what you think of this company, if you invest in them or not, if you're thinking about it, and let me know of any good points that I've missed and what you think you can have a look at. So don't forget to like the video, guys. Subscribe if you haven't already. I much appreciate it. So on that note, I'm going to leave you to it today. Take care.